Welcome back everybody to the final video in the series of trading vertical spreads. Now, in this video we're going to talk about when to potentially take profits or losses when trading the vertical spread strategies, and more specifically I'm going to give you some guidelines and tell you when it may be logical to take profits or when to take losses. So let's get into it. Now, unlike buying call or put options, all vertical spread strategies have limited profit potential. Now, the fact that these strategies have limited profit potential is actually a benefit to you as a trader because it makes the decision of taking profits much easier than if you were just trading long calls or long puts. And that's because when you're trading long calls or long puts, you have significant profit potential and your mind will start to play tricks on you if you have a winner because naturally you'll want to hold the trade longer and you may not know when to take profits because you really don't know how much you can make on the trade. So let's go ahead and take a look at an example to illustrate why it may be easier to determine when to take profits when trading vertical spreads. Now in the following chart, we're looking at the performance of a bull call spread, which is constructed by the long 120 call and the short 130 call, and the spread is bought for $5.40. Now, since this is a $10 wide call spread, the maximum value that the spread can trade for is $10. So as we can see here in the chart, the stock price is around $127 at the beginning of the period when the call spread has 45 days until expiration. Now, fortunately for this trade, the stock price increases and heads to around $145 at the highest point. Now, as we can see, the value of the spread increases dramatically from $5.40, and at around 28 days to expiration, the spread is worth around $9. Now keep in mind that the maximum value of the spread is $10. Now that means the closer the spread's value gets to $10, the more logical it is to take the trade off for profits because you have less to make on the trade and more to lose. So in this example, if you buy the call spread for $5.40 and the spread trades to $9, you would be up $360 per spread, and your maximum profit potential on the trade is $460. So if the spread's value gets to $9, you can only make another $100 on the trade, but you can lose the entry price of $540 plus the $360 in profits that you currently have, which means you can lose $900 and you only have $100 left to make. So when you're trading vertical spreads, the further the spread moves in your favor in terms of price, the more logical it is to take the trade-off for a profit because the risk to reward of continuing to hold that spread swings against you. Now when buying call spreads or put spreads, it becomes less logical to continue holding the spread the closer it gets to its maximum value. Now when you buy the spread, you want it to increase in value, and therefore its maximum value being the width of the strikes, the closer the value of that spread is to the width of the strikes, the more logical it is to close the trade because the risk to reward is less in your favor than it was at the time of entering the trade. Now more specifically, the reason is because you have less profit to make and more to lose. So initially, right when you buy the spread, you can only lose the entry price that you paid for that spread. Now, when the spread moves in your favor and increases, now you can lose the entry price plus the profits that you have at that current time, and therefore you have more risk and less reward. Now what about when you sell spreads? Well, when you sell a call spread or put spread, it becomes less logical to continue holding the spread the closer its value gets to $0. And that's because when you sell a spread or you sell an option, the best case scenario for you is if that option expires worthless and its value reaches $0. So for instance, if you sell a spread for $5, your maximum profit potential is $500. So if that spread's value drops to 50 cents, you only have $50 left to make on that trade, but now you can lose basically your initial risk plus the profits that you have at that time. Alright, so to demonstrate to you what I mean, let's go ahead and look at a quick example using the SPY ETF. So this is the S&P 500 ETF. Now let's say we go ahead and buy a call spread in SPY, and let me just queue one up really quickly. So let's say you go to September options and you buy the 240 call, and then you sell the 250 call. Okay, so as we can see, this spread is trading for $7.26, and let's just round that off to $7.25. Now when we look at the risk profile, the current price of SPY is right around $247. So since we purchased a $10 wide spread for $7.25, the most we can lose is $725 at expiration. The most we can make is $275. Now this blue line right here represents the expiration payoff diagram, and the pink line represents the estimated P&L of this spread based on SPY's price today. So for instance, if SPY increased to $250, then we're estimated to be up about $120 on this spread out of the maximum $275. However, what if SPY increased to $255? Well, in that case, we're expected to be up $240 out of the maximum profit potential of $275. So if this were to happen, hypothetically, what would be the right decision to make when we buy this spread? Well, if you can only make $275 on the spread and your profit on the spread reaches $240, then you can only make another $35 on the trade, but you can lose everything you paid for the spread plus your profits at that time, so it would make sense just to close that spread. Now to quickly recap, when buying vertical spreads, it becomes more logical to close the position when the trade gets closer to the maximum profit potential. Now that means when the spread's value gets closer to the width of the strikes. So if you buy a 25-point wide call spread or put spread, the closer that spread's price gets to $25, the more it makes sense to take profits. Now on the other hand, when selling vertical spreads, it becomes more logical to close the position when the spread's value gets closer to $0. Now that's because when you sell a spread, the point of maximum profitability occurs when the spread is worthless. So if you sell a spread, keep an eye on its price, and the closer its price gets to $0 or being worthless, the more it makes sense to close that trade because you have less to make on the position and more to lose. Now what about taking losses? Well, since vertical spreads have limited loss potential, determining when to take losses can be tricky because the larger the loss gets, the less it makes sense to lock in that loss by closing the spread. Now why is that? Well, since you can only lose so much when trading vertical spreads, the risk to reward swings heavily in your favor if the trade moves against you. And that's because since you have limited loss potential, the closer your loss gets to that maximum loss potential, the more you have to gain and the less you have to lose. So if you sell a spread, for example, and your maximum loss potential is $500, if that trade moves against you and you're down $450, then you can only lose another $50 on the trade, but you can make back the $450 in losses, plus you still have that profit potential if the trade moves back in your favor. So let's go ahead and look at a quick example just to show you exactly what I mean. Now in this chart, we're looking at the performance of a bull put spread, which is when you sell a put and then buy another put at a lower strike price. And in this case, we're looking at the 140-135 short put spread. So we're selling the 140 put and we're buying the 135 put, and we're selling the spread for a net credit of $1.66. Now since this spread is 5 points wide, the maximum value that this spread can reach is $5. Now what does that mean for the put spread seller? Well, if you sell a $5 wide put spread for $1.66, that means the most you can lose per spread is $3.34 in option terms, or $334 in actual losses. Now in this example, the put spread is sold when the stock price is right around $140, and unfortunately the stock price immediately collapses and trades through the put spread strike prices. Now, as the stock price is decreasing and time is passing, we can see that the value of this put spread is increasing, and that means the put spread seller has losses. So at around 4 or 5 days to expiration, we can see that this put spread is trading for around $4.50, which means the put spread seller can only lose another $50 on that trade. So since they can only lose another $50, but they can potentially make $450 from that current point, then the risk to reward relationship says that the trader should definitely hold the spread if they can take that maximum loss potential. Now, of course, whenever you're selling spreads or buying spreads, you need to be aware that taking the maximum loss potential is a very real possibility, so it's always advised to size your trades accordingly. Alright, so let's go ahead and look at another example using a spread from today's option prices. Alright, so for this example, I'm going to use everybody's favorite stock and car right now, Tesla. So right now, Tesla is trading for around $347 per share, and the stock is up 6.5% after an earnings report yesterday. So let's go ahead and say a trader believes that this upward movement is going to continue, so they're going to go ahead and sell a put spread. So let's say the trader is fairly aggressive with their assumption, and they're going to sell the 340 put and buy the 330 put to create their bull put spread. Now let's go ahead and queue that trade up in the September options with 43 days to expiration. So we're going to sell the 340 put and buy the 330 put for a net credit of, let's just say, $375. So let's go ahead and look at the risk profile. So right now Tesla is right around $347, and since we're selling a $10 wide put spread for $3.75, the most we can make on this trade is $375 if Tesla is above 340 at expiration, and the most we can lose on this trade is $625 if Tesla is below 330 at expiration. And we can see the expiration P&L and P&L estimations for today by looking at those numbers in the bottom left-hand corner. Now let's go ahead and say that the trader is initially wrong and Tesla falls to $330 tomorrow. Well, we know we can lose a maximum of $625 on the trade, and if Tesla goes to 330 today, then we'll be down about $155 on the trade. So at this point, should the trader take the loss? Well, in my opinion, it would be a better time to take the loss with a loss of $150 out of a potential loss of $625 because you still have a lot of money to lose on the trade. So if the trader is initially wrong right away, I think it would be better to take the loss early than compared to if you take the loss later on, because as we can see here, let's say Tesla falls all the way to $300. Well, then at that point, the trader is expected to be down about $415 out of a possible $625. So as the loss gets larger and larger and the spread's value gets closer to $10, it's going to be actually less favorable to take the loss because there's only so much left to lose on the trade. But if by some miracle Tesla were to rally all the way back, you could make back all of your losses plus the $3.75 credit that you initially received. So what am I saying here? Well, when you're trading vertical spreads, the larger your loss gets, the more it makes sense to actually hold that trade and give yourself more time because you can only lose a little more, but you have everything left to gain. However, if you are going to take a loss on a vertical spread, it is more logical to take that loss earlier on because if you just have a smaller loss, so for example, if Tesla goes to 330 tomorrow and you realize, maybe I was a little too aggressive, then you only have a loss of $150 out of the maximum potential loss of $625. I hope you found that demonstration valuable, and just to recap, when taking losses and trading vertical spreads, taking losses actually becomes illogical the larger the loss gets because you have more to gain and less to lose. So always keep in mind what the risk reward is based on your current profits or losses when trading vertical spreads. Now, as a disclaimer, I have to say that if a trader is sizing up and cannot take the maximum loss potential of that spread, then a loss-taking strategy should be thought out before entering the position. So the only time that I would really recommend taking losses when trading vertical spreads is earlier on when you realize that you maybe were a little bit aggressive and your directional assumption changes, but also if you're sizing up the trade and using a lot of leverage and you can't take the maximum loss potential, then you need to have a loss-taking strategy that you have thought out before you actually put that trade on. Thank you so much for watching this video series, everybody. I hope you learned a ton about vertical spreads and enjoyed all the commentary related to them. If you enjoyed these videos, please give the videos a like and subscribe to our channel so that you can get all of our options trading videos as they come out in the future.